How do you suggest that new investors look at this market in terms of expectations, and where should they be putting their money?
Sure. So first thing is that they should be cognizant of the fact, and I want to emphasize the word that you used, existing investors. So the returns that they are seeing today belongs to investors who invested 10 years ago or 5 years ago, right? Which means that to expect the same kind of return is
Yes.
slightly out of place. So that is the starting point where you need to get the expectations right. So for example, no market in the world
Correct.
has delivered high double-digit returns if the starting valuations were more than 23 times where we are trading today. So first starting point is to tone down
Yes.
return expectation. Second, also to look at other attractive asset classes where possibly the assets are not as overheated or they are in low cycle. That could be another important ingredient. For example, adding a flavor of debt securities, adding a flavor of gold and silver to your portfolio, or some global equities to your portfolio. That could be a good multi-asset kind of an approach. I think that could be a very good starting point. Third, if investors are uncomfortable with other assets and want to stick to equity and debt, then possibly looking at equity savings as a category or a dynamic asset allocation as a category. I think these are good starting points for investors today. And within equity, our orientation is to look for large caps. We think that the margin of safety is much better in large caps versus rest of the market. And in fact, within large caps, we would be we will have better margin of safety in the largest cap companies, which are the large cap of the largest. So I think that is where the comfort will lie.